The interim budget for the financial year 2024-25 walked the talk as far as fiscal consolidation is concerned. Finance Minister Nirmala Sitharaman has pegged the fiscal deficit target at 5.1% of the GDP for the new financial year, down around 70 basis points from 5.8% target for FY24. This is also lower than the market expectation of 5.2 to 5.4%. Add to it, against analysts' estimate of gross market borrowing at 15.43 trillion rupees, the interim budget has pegged the same at 14.13 trillion rupees for the new fiscal. By comparison, gross borrowings are budgeted at 15.43 trillion rupees for the current fiscal year. Net market borrowing, meanwhile, has been pegged at 11.75 trillion rupees. The glide path's impact was seen immediately on bond yields. The yields on 10-year government securities cooled off 10.5 basis points intraday to hit a low of 7.039%. They eventually ended at 7.057% on Thursday, 1st February, as against 31st January, close of 7.144%. These fiscal numbers, analysts said, are expected to cap the rise in bond yields in the coming months.
I think from a technical perspective, it will go below 7 and probably test 6.9%. While the economy is expected to grow at around 10.5%, the revenue is expected to grow by only 12%. That probably means that the revenue or tax buoyancy, which was expected to be close to 1.4, has been underestimated. And this is in line with the finance minister's ongoing theme of promise over deliver.
So, will the government's fiscal gliding path soothe bond markets and in turn equities if they were to falter due to geopolitical risk and nervousness due to the general election back home? According to analysts, select equities which are dependent on market borrowings will benefit from softening bond yields in the near term. However, they caution that it may be too early to cheer the dip in bond yields from long-term perspective, especially at a time when India will be included in a major global bond index later this year.
The numbers on the fiscal deficit that have been projected, 5.1%, seems quite aggressive. I mean, I don't see how that is going to be met. And that is the real question. I think the large caps will be very tepid, and especially given the headline nominal GDP growth number, which I think is about 10.5% or so for large capitalized, because large caps need a strong nominal GDP growth numbers in order to grow. So I think the large caps will continue to be very tepid. On the other hand, I think small caps are going to be absolutely on a roll.
As lower than anticipated fiscal deficit and gross borrowing put debt markets in a sweet spot, it has bolstered the outlook for select equity pockets, especially banks. On 2nd February, markets will react to the fine print of interim budget along with Q3 results and global cues.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.
She's working her way to the corner office. Business Standard.